The United States economy is currently navigating a critical period, with investors on edge as they await crucial economic data. According to Citi economist Veronica Clark, we could see the Federal Reserve initiating interest rate cuts as soon as September, with further cuts at every subsequent meeting. This prediction hinges on signs of a weakening labor market, evidenced by a rising unemployment rate. The big question is whether the economy will manage a soft landing or weaken further. This juxtaposition underscores the delicate balance the Fed must strike in its monetary policy. The upcoming week promises to be pivotal, with new inflation data potentially solidifying the case for these interest rate cuts. Clark emphasizes the importance of understanding the broader economic dynamics and how they impact future Fed decisions. As we brace for these critical updates, one must ponder, how will these economic shifts influence the everyday lives of Americans, and what can we expect in the coming months? STEP2, new article. U.S. economy in a trade-off era: rate cuts or labor data? As we navigate an era marked by economic uncertainty, investors are bracing themselves for a week filled with significant data releases. Veronica Clark, a leading economist at Citi, recently shared her insights on market domination, offering a detailed outlook on the current state of the U.S. economy. Clark predicts that the Federal Reserve could begin cutting interest rates as early as September, followed by additional cuts at each subsequent meeting. This forecast is built on the premise of a softening labor market, but there are concerns that rising unemployment figures could increasingly trouble Fed officials. We're kind of in this trade-off era. Are we going to have a soft landing? Are we going to weaken further? Clark tells Yahoo Finance, "I think we have a much easier time now than maybe a couple months ago convincing people that things are slowing down." This shift in narrative from a potential economic reacceleration to a likely slowdown marks a significant change in the economic outlook. Macroeconomic overview. The broader economic context is crucial as we anticipate new inflation data this Thursday, which could bolster the case for the Fed to initiate interest rate cuts in September. Veronica Clark's insights highlight the nuanced understanding required to navigate these economic waters. It's not merely about when the rate cuts start, but also the frequency and duration of these cuts. According to Clark, Citi projects consecutive rate cuts following the initial cut in September, spanning through November, December, and into the first half of next year. This consecutive cut call is increasingly supported by signs of a weakening labor market, despite recent strong payroll numbers. Labor market dynamics. The labor market remains a critical focus, with the unemployment rate now at 4.1%, surpassing the Fed's year-end forecast. This uptick in unemployment is particularly concerning for Fed officials and could drive the anticipated consecutive rate cuts. Most recessions, most downturns start very gradually, and then at some point you encounter nonlinearity, Clark explains. The rise in initial jobless claims suggests we might be on the brink of such a tipping point. Gradual deterioration. For months, there have been signs of a gradual pullback in hiring, with a notable reduction in hours worked. Employers are increasingly looking to cut labor costs, initially by reducing hours rather than laying off workers. However, as the job market tightens, finding new employment becomes more challenging for those who lose their jobs. This dynamic has led to a pullback in consumer spending, with retail sales moving sideways or slightly lower for several months. Reduced consumer spending impacts business revenue, potentially leading to further layoffs and a deeper economic downturn. Fed's testimony and inflation data. Central bankers, including Fed Chair Jay Powell, are set to appear on Capitol Hill this week for semi-annual testimonies. Powell's statements will be closely scrutinized for indications of the Fed's stance on the labor market and inflation. Clark anticipates that Powell may sound relatively dovish, reflecting growing concerns about the labor market. At the same time, inflation appears to be moving in the Fed's favor, with expectations for a benign reading in the upcoming Consumer Price Index, CPI report. A 0.2% month-on-month increase in core CPI would represent a very normal reading, potentially indicating a slowdown in shelter inflation, a stubborn component of overall inflation. Such a favorable inflation reading could reinforce the Fed's confidence that inflationary pressures are easing, paving the way for the anticipated rate cuts. Conclusion. The U.S. economy stands at a crossroads, with significant implications for future monetary policy and economic stability. Veronica Clark's insights underscore the delicate balancing act the Federal Reserve faces as it navigates the trade-off between a soft landing and further economic weakening. As we await this week's critical economic data, one must reflect on the broader implications. How will these economic changes impact our daily lives? And what measures can individuals and businesses take to prepare for potential shifts in the economic landscape? Share your thoughts on how you believe the evolving economic scenario will affect you and your community.